GameStop counter short sellers put the squeeze on big institutional investors, and Robinhood put a stop to it. It's about to get real, and we're going to go over what happened, how it went down, and the fallout of it all in this video. Plus, if you stick around to the end, we'll tell you how you can use this knowledge to make passive income, or not. So be sure to click that button for the YouTube algorithm. Like I mentioned, it's about to go down. But before we get into the good stuff, welcome to Finance Squared. I'm your host, Derek West, and on this channel, we love to talk everything personal finance, including topics concerning stocks, bonds, index funds, ETFs, REITs, and exotic investment instruments, and techniques, including selling short, selling long, things of that nature. As a matter of fact, I did a whole video on that topic not too long ago. Be sure to check it out in the video card above. But that info is going to be useful, really useful, when we get into what really happened with the GameStop stock. That's hard to say. Say that 5 times fast, I dare you. GameStop stock, and how it really went down, along with Robinhood's involvement in all of this. So by now, if you follow financial news or internet news, or watch late night TV, you've probably heard of the whole GameStop Short Squeeze controversy. Don't you love just how everything has become a controversy nowadays? Well, the GameStop squeeze, brouhaha, if you will, has become one as well. There are some pretty good videos out there on the topic by a couple of really good YouTubers that I like. For instance, folks like Graham Stephan, Meet Kevin, and this Guy JJ Buckner, whom I just discovered. They all did a pretty good job of explaining essentially how the stock market was manipulated to help entrenched financial institutions and some pretty heavy hitters. That being said though, I find whenever watching videos on topics similar to this, it's always good to get multiple perspectives to A, make sure you understand what the heck is really going on, and B, figure out who really knows what the heck they're talking about. So with that, here's my take on what happened, what the fallout is, and what is likely to happen next, starting with what the heck is a short squeeze, and most importantly, how you can profit from this knowledge, or not. Now you know me, I like to try and keep things nice and simple. People who are new to this topic, and even trading stocks in general, might just not understand all of the jargon associated with this whole brouhaha. So let's not even talk about trading stocks, because that can just cause more confusion. Let's imagine we're trading something else that you might find valuable. Like, for example, an 80-inch flat screen television, LED. Typically, the price of such items fluctuate most often around specific times of year. For example, Black Friday, Cyber Monday, the whole holiday time, and during the time when the Super Bowl is about to come on television. Early February, late January timeframe. Now, there are some arguments of whether retailers are just jacking up the prices to offer discounts and amazing savings to lure customers in. Nevertheless, one cannot argue that the prices indeed fluctuate because of this. And let's imagine, and journey with me if you will, and imagine to yourself that the price of this flat screen TV is around $5,000. I haven't checked the price of 50-inch LED screens in quite a while, so I may be a little bit off on that. Hopefully you can forgive me. But if you think the price of the big screen TV is going to go down, and you are a profit-motivated individual, that is to say, you don't want the TV just for the sake of having the TV, but you want the TV for the purpose of making money, which is why people would buy stocks, bonds, or options in the first place. What you would do in that situation is that you would borrow the TV from someone you know that already has that 80-inch LED TV that you know everyone lusts after. The assumption being he's not using it at the time, and because of this, he lends you the TV for about $50 a week. But assume you sell the TV at the retail price of roughly $5,000. If you're expecting the price to fall, your hope is, and the bet is actually, that the price falls far enough that you profit once your friend demands to have the TV back. As an example, if the price falls to $500, in one of those Black Friday sales, you would buy the same type of TV at that price, keeping in mind you've already sold the TV your friend lent to you for 5,000 big ones. If you give that person back the TV that you repurchased at $500, you make a large profit of $4,500 minus the weekly fee your friend charged to you. If it took 2 weeks for the price to fall, as an example, that would be $100. So the profit that you would have made would be $4,400 by only spending $100 borrowing the television from your friend. Sounds freaking awesome, right? Why doesn't everyone do that? With stocks, bonds, and even big screen TVs. Well, as I'm sure you might have imagined by now, there are real and substantial risks to this kind of strategy, including owing somebody theoretically infinite money. How can that happen? Let me explain. Remember that I said that your friend is fickle. When he wants his TV back, he must have it back. What if when he wants it back, the price of the TV has not fallen, but risen? So remember, you sold it for $5,000. What if when your friend wants it back, the price has gone to $8,000? When you buy it back for your friend, you need to pay an extra $3,000 to get the actual television back, plus whatever fee you paid for borrowing it from your friend. Now, someone who's watching you makes these moves, like, for example, a shrewd and mischievous individual who likes to browse Wall Street bets. If that person notices what you're doing, they could buy up all the TVs, making sure that you have none to buy back when your fickle friend demands to have his TV back. That, dear friends, is a short squeeze. But wait, it gets worse. Let's say a hedge fund who is putting this move on a stock or a specific TV. Imagine you promise to sell me 1,000 TVs for $50,000 each at any point in the next 3 months. So effectively, I have the option of buying televisions, a certain amount of them at a fixed price at any point in the next 3 months. If the normal price of TVs was just $5,000, any broker of those options would love to sell them to you for dirt cheap. Why? Because there's no way the price is going to go that high, right? Right? Who would buy TVs for $50,000 nowadays anyway? Am I right? No one would buy TVs for that much, right? That seems like a ludicrously large amount of money for a television. If there are people willing to buy those options, then they will be willing to sell you that option without hesitation. They might go so far as to sell you half or more of all televisions in the entire world, because the price is never going to get that high. So they will never have to actually ship you any TVs. But then, like in our previous scenario, people start to put the squeeze on TVs. What was once a $5,000 TV goes to $10,000. At this point, the people who are selling you that option are starting to think that they may have to deliver on some of that promise, meaning that you have to buy some TVs to cover your bets, making the price of those TVs go to, let's say, $25,000. This is all examples, by the way. More and more people start to notice, and they start to buy TVs as well, hoping that they can get in on the run-up in the price, driving the price even higher. So the people who sold the options start to panic more and more and start buying more and more televisions. And if there are enough people buying because they sold the TVs short, and enough buying because they sold options that they never thought would ever have to be fulfilled, and a dwindling supply of TVs because of other buyers that are holding them ransom because they're trying to squeeze them short, then theoretically the price of TVs could go to infinity. And if you purchased the TVs short, that is, you bought it at $5,000 hoping the price would fall, you now owe an infinite amount of money. But that is essentially what was being done to GameStop stock. Again, I dare you to say that 5 times fast. Some hedge fund and series of hedge funds actually was shorting GameStop stock, not big screen TVs, but basically borrowing to purchase GameStop stock at a certain price, betting that that price would fall. But there were, and are, people who watch hedge funds like a hawk for tactics just like this, who wait for the right opportunity to put the squeeze on short sellers and actually other selling tactics as well. But why GameStop? Well, why not GameStop? Institutional investors who are familiar with and competent in executing exotic investment strategies like selling shorts or puts or options in general are out looking for companies and opportunities to exercise those strategies. As a quick example, in 2009, Volkswagen was in a similar situation when its parent company, Porsche, announced the number of shares that it owned of the company were many more than had been previously reported. I'm not sure if it was just an error on their parts or what, but they owed more shares than anyone thought that they did. So the supply of those shares completely dried up. And brokers demand for folks who were shorting the stock to put more money into their margin accounts to cover their short positions, which drove the price of Volkswagen through the roof. At one point for about 15 minutes, Volkswagen was the largest company in the world by market capitalization. And a quick definition of market capitalization for you. That is the dollar value of all outstanding shares of a company at current market price. But companies and institutional and even retail investors think are in an industry or market segment that is in a downtrend or ripe for disruption are typically targeted for short selling of their stocks. And GameStop, if we're being honest with ourselves, is one such company. As I'm sure you're aware, nowadays, with options to stream pretty much any movies or games and any game you want, there really is no reason whatsoever to walk into a GameStop. Ask yourself, when was the last time you were in a GameStop? I probably haven't been in one since the Xbox 360 was released what seems like a lifetime ago. So what is Robinhood's involvement in all of this? So folks who follow the subreddit, Wall Street Bets, believe the company was being undervalued. That is, its stock price wasn't reflecting the true value that it was providing its shareholders, its customers, and other stakeholders. One of those dudes was Keith Gill, who happens to have a YouTube channel, who, like this channel, loves to talk about finance and specifically his position in certain investments. Keith purchased $53,000 in call options on GME. That's the symbol for GameStop stock in 2019. And because he weathered the storm between then and presumably January 27, 2021, he saw the value of those options go to $48 million. There were also some folks who were looking to put the squeeze on those who short sell. And a ton of folks were using the Robinhood app, so named after the infamous rogue who, quote, robbed from the rich to give to the poor. Whatever you think of the moniker of the app, it certainly didn't live up to its name on that day, because on January 28th, in response to the run-up of the stocks of GameStop, AMC Theaters, BlackBerry Limited, NOKIA Corporation, and other stocks, Robinhood suspended the ability for users to trade in those stocks. That is, they stopped people from buying and selling them. Other exchanges soon followed suit and discontinued trading in those particular stocks. Now, of course, as you might imagine, there was outrage for this because retail investors took the opportunity and the freedom that they had to purchase stocks of companies that they felt were undervalued, or even if they just wanted to oppose the shorting of the stocks, and those exchanges, from the perspective of retail investors, didn't allow them to continue and purchase the stocks they wanted to purchase, for whatever the reason was. Now, it's claimed by Robinhood and a couple of other brokerage firms that the reason for stopping trading was the clearinghouses themselves. The folks who borrowed TVs from our example in the beginning. Those folks were raising the required collateral for executing trades. Now, you see, because there is a lag between the moment when an investor purchased a security and the moment cash and securities are actually exchanged, brokerage firms have to post collateral at clearinghouses to guarantee the proper settlement of client orders. You've probably never even heard of some of the names of these corporations, so I'm just going to drop them for you just so that you have the knowledge for yourself. But companies like Depository Trust and Clearing Corporation for equities, and Options Clearing Corporations for options. The claim is that the increased collateral could not be provided in time, and therefore the squeeze was being put on them to execute the trades of their customers. Meaning they were trying to protect themselves from not having the capital to execute the trades, not that they were trying to protect hedge funds. And if you kind of think about it, it does sort of make sense. Now, I do not know if it's true or not, but oftentimes people don't understand the ripple effects of simply executing trades. It can be quite complex, and it's not as simple as pressing a button on your smartphone. It seems that simple because they make it look that simple. But a lot of things have to happen in the background for you to actually own that stock once you select it to be owned. However, the outrage had been established, and people of all political stripes, left, right, center, were in agreement that what Robinhood and other brokers did was effectively protect hedge funds against huge losses. Melvin Capital, a hedge fund that was shorting GameStop, lost 30% of its value since the start of the year. Citadel LLC and other major funds lost $2.7 billion in trying to cover their positions. And according to Morgan Stanley, on January 26, 2021, short sellers lost a total of $6 billion due to the squeeze executed by retail investors. The fallout from this could potentially be quite large for Robinhood and other brokerage accounts. With promises of congressional hearings on the matter and attorney general investigations from both New York and Texas, along with the Securities and Exchange Commission announcing that it would be reviewing the incident with the aim to protect retail investors. In addition to that, at least one class action lawsuit has been filed against Robinhood, alleging that Robinhood purposefully, willfully, and knowingly removed the stock from trading during the midst of an unprecedented stock rise, and thereby depriving retail investors of the ability to invest in the open market. Also alleging that Robinhood manipulated that open market. Where will this all go? Only the future knows. The only thing that I know is that if you want a nice passive investment where your money grows at a nice safe 8% a year, then simply buy an index fund, an ETF, or a REIT that grows without you having to do much. If you want to live on the wild side, however, get involved in investments that could increase over 1,000% in a month and really bet big, but maybe lose bigger. Get into short selling and counter short selling by going long on certain stocks. Also, make sure to subscribe to this channel where we go over exotic trading instruments just like this. Take a look at some videos we did recently on the topic in the video card above. Also, be sure to turn on post notifications as we will be doing videos on this topic just like this in the very near future. And you want to be there when those videos drop. Keep in mind, a goal without a plan is a wish. A goal with a plan and no action. Now that's a wish list. Take action on your plan to counter short sellers by buying undervalued stocks today, or just invest in index funds to get safe passive income. In either case, I'll catch you next time. Peace.